I need you to understand something that just happened in the gold market, something that hasn't occurred in over a decade. And if you miss what I'm about to show you, you could be looking back 6 months from now wondering why you didn't pay attention. Gold just shattered through a resistance level that's held firm since 2011. We're talking about a technical barrier that's been tested, rejected, and defended for 10 years. And it didn't just break through. It exploded through with the kind of volume and conviction that tells you something fundamental has changed in the market. Let me paint you a picture of what this actually means. Imagine a dam that's been holding back water for a decade. Engineers keep inspecting it, reinforcing it, watching the pressure build year after year. Then one day, a crack appears. Not a slow leak. A crack that turns into a rupture that turns into a complete structural failure. That's what just happened in the gold market. The resistance level I'm talking about is the $2,075 mark. This wasn't just any price point. This was the line in the sand that separated the 2011 bull market from everything that came after. Every time gold approached this level over the past decade, sellers showed up. Central banks, commercial traders, institutional players, they all defended this line like it was sacred ground. Until now. On November 8th, gold didn't just touch $2,075, it blew through it, closed above it, and never looked back. We're now trading at levels that would have seemed impossible just months ago. But here's what most people are missing. This isn't just about a number on a chart. This is about what happens when a 10-year resistance becomes support, when the ceiling becomes the floor. Let me take you back to 2011 for a moment, because you need to understand the significance of that year. Gold hit $1,921 per ounce in September 2011. The world was reeling from the 2008 financial crisis. Quantitative easing was in full swing. The dollar was under pressure. And gold was the safe haven everyone was piling into. Then, something changed. The Federal Reserve signaled they were going to taper their bond buying program. The dollar strengthened, and gold entered what would become a brutal bear market that lasted until 2015. It lost nearly 45% of its value, bottoming out around $1,050. Fortunes were made and lost. Gold bugs who had been right for a decade suddenly found themselves on the wrong side of history. But here's what's fascinating. Even as gold recovered from that 2015 low, even as it climbed back above $1,500, then $1,800, then $2,000, it could never quite break through that 2011 high with any conviction. It would get close, maybe touch it for a day or two, then sellers would emerge and push it back down. This happened in 2020. It happened in 2022. It happened multiple times in 2023 and 2024. Until now. So what changed? Why did this resistance level that held for 10 years suddenly give way? And more importantly, what does this mean for where gold is headed next? The answer isn't simple, and it's not just one thing. It's a convergence of forces that have been building for years, all coming together at the same moment. Let me break down what's really happening behind the scenes. First, look at what central banks are doing, not what they're saying, what they're actually doing. In 2023, central banks bought more gold than any year since 1950. We're talking about 1,037 tons of gold purchased by central banks in a single year. That's not a trend. That's a stampede. China's central bank has been buying gold for 17 consecutive months. The People's Bank of China added 225 tons to their reserves in 2023 alone. But here's the kicker. Most analysts believe China's actual gold holdings are far higher than what they officially report. Why? Because China has a strategic interest in understating their gold reserves while they're still accumulating. They don't want to drive the price up before they're done buying. Poland's central bank governor came out publicly and said they plan to increase gold reserves to 20% of their total reserves. 20%. Think about that. This is a NATO country, a Western-aligned nation, saying they want 1/5 of their national reserves in gold. That's not a vote of confidence in the dollar system. That's a hedge against what they see coming. Turkey, India, Singapore, the Philippines, they're all adding to gold reserves at a pace we haven't seen in generations. These aren't fringe nations. These are major economies making a calculated decision to diversify away from dollar-denominated assets and into physical gold. But it's not just central banks. Look at what's happening in the ETF market. Gold ETFs saw outflows for most of 2022 and early 2023. Retail investors were selling. The smart money was buying. Now, in late 2024 and into 2025, we're seeing those ETF flows reverse. Retail is starting to wake up to what institutional players figured out 2 years ago. The Spider Gold Trust, the largest gold ETF in the world, has seen its holdings increase by 12% since the start of 2024. That's billions of dollars flowing into physical gold-backed securities. And this is happening while gold is making new all-time highs. Usually you see retail chase performance. This time, they're buying into strength, which tells you the conviction is real. Now let me show you something that should make your hair stand on end. The relationship between gold and real interest rates has completely broken down. Traditionally, gold moves inversely to real rates. When real rates go up, gold goes down. When real rates go down, gold goes up. It's been one of the most reliable correlations in financial markets for decades. Except it's not working anymore. Real rates have been rising, and gold is rising right alongside them. This shouldn't be happening according to traditional models, but it is. And you know what that tells me? It tells me there's a force in the market stronger than interest rates. There's a demand for gold that transcends normal financial calculations. That force is fear. Not panic fear, strategic fear. The kind of fear that makes central banks and sovereign wealth funds look at the global financial system and decide they need insurance. Real, physical, hold-it-in-your-hand insurance. Think about what's happened in the last 5 years. We've had a global pandemic that shut down the world economy. We've had supply chain disruptions that exposed how fragile our just-in-time systems really are. We've had inflation rates not seen since the 1970s. We've had bank failures, including Silicon Valley Bank and First Republic, that reminded everyone that even in 2023, banks can still collapse overnight. We've had the Federal Reserve raise interest rates at the fastest pace in 40 years, taking the Fed funds rate from near zero to over 5% in less than 18 months. We've had the U.S. government add $7 trillion to the national debt in just 5 years. We're now sitting at $34 trillion in total debt, with interest payments alone exceeding $1 trillion per year. And here's the thing that keeps me up at night. We've had the weaponization of the dollar. When the U.S. froze Russia's dollar reserves after the Ukraine invasion, every central bank in the world took notice. If the U.S. can freeze Russia's reserves, they can freeze anyone's reserves. That was a watershed moment that doesn't get talked about enough. Suddenly, holding all your reserves in dollars or dollar-denominated assets isn't just an economic decision. It's a geopolitical risk. And the only asset that can't be frozen, can't be sanctioned, can't be controlled by any single government is gold. Physical gold, sitting in your own vault. This is why the BRICS nations are talking about a gold-backed currency. This is why Saudi Arabia is reportedly in discussions to accept yuan for oil payments. This is why we're seeing a slow-motion restructuring of the global monetary system. And gold is at the center of it all. Now, let me address something important here, because if you're sitting on retirement savings, this matters to you personally. A lot of people have their wealth tied up in traditional retirement accounts, 401ks, IRAs, accounts that are heavily weighted toward stocks and bonds. And that's been the right move for decades. But we're entering a period where the old rules might not apply. Quick aside here, if you've got $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs actually work. It's linked in the description below. It walks through how you can get physical gold into your retirement account without triggering tax penalties, how the custodian system works, what the fees look like, all of it. Worth checking out if you're thinking about diversifying your retirement holdings. No pressure, just information, if it's relevant to your situation. All right, back to what's happening in the market right now. Because the technical picture is just as compelling as the fundamentals. When a major resistance level breaks, especially one that's held for a decade, it doesn't just become meaningless. It becomes support. That $2,075 level that was the ceiling for 10 years, that's now the floor. And every time gold pulls back to test that level, you're going to see buyers step in. Why? Because traders know that a broken resistance becomes support. It's one of the most reliable patterns in technical analysis. But here's where it gets really interesting. Look at the volume profile when gold broke through $2,075. We're talking about massive volume, the kind of volume that indicates institutional participation. This wasn't retail traders pushing gold through resistance. This was big money, smart money, patient money that had been waiting for this moment. And the momentum indicators are all pointing in the same direction. The relative strength index is showing strength, but not overbought conditions. The moving average convergence divergence is showing a bullish crossover. The 50-day moving average just crossed above the 200-day moving average, what traders call a golden cross. These are all signs that this move has legs. Now, I know what some of you are thinking, but gold is at all-time highs. Isn't it too late to get in? Shouldn't I wait for a pullback? Let me tell you a story that might change your perspective. In 1979, gold was trading around $200 per ounce. It had been in a bull market for several years, and it was making new highs. A lot of investors thought they'd missed the move. They decided to wait for a pullback to get in at a better price. By January 1980, gold had hit $850 per ounce. It more than quadrupled in less than a year. Those investors who waited for a pullback, they never got one. At least not until after gold had already made its parabolic move. I'm not saying we're going to see that kind of move again, but I am saying that waiting for a pullback in a strong bull market can be a costly mistake. Sometimes the best entry point is right now, even if it feels uncomfortable buying at all-time highs. Let me show you what the supply and demand picture looks like, because this is where things get really interesting. Gold mine production has been essentially flat for the last 5 years. We're producing about 3,000 tons of gold per year globally, and that number isn't growing. Why? Because it takes 10 to 15 years to bring a new gold mine online, and the easy gold has already been found. The gold that's left in the ground is deeper, lower grade, and more expensive to extract. Mining companies need gold prices well above $1,500 per ounce just to make new projects economically viable. And even then, environmental regulations, permitting challenges, and local opposition make new mine development incredibly difficult. Meanwhile, demand is surging. Central banks are buying at record levels. Jewelry demand in India and China remains strong despite higher prices. Industrial demand for gold in electronics and technology is growing. And now, with gold breaking through major resistance, you're going to see investment demand accelerate. This is a classic supply-demand imbalance. Flat supply, growing demand. Economics 101 tells you what happens next. Prices go up. The only question is how much and how fast. Let me give you another historical parallel because history doesn't repeat, but it often rhymes. In 2005, gold was trading around $450 per ounce. It had been in a quiet bull market since 2001, but most investors weren't paying attention. The mainstream financial media was focused on real estate and tech stocks. Gold was boring. Then, something shifted. In 2006 and 2007, gold started making new highs. It broke through resistance levels that had held for years. And suddenly, everyone wanted to know about gold. By 2011, gold had hit $1,921, more than quadrupling from those 2005 levels. The investors who made the most money weren't the ones who bought at the bottom in 2001. They were the ones who recognized the trend in 2006 and 2007 and stayed with it. They bought into strength. They ignored the naysayers who said gold was overvalued, and they were rewarded handsomely. I'm seeing similar patterns now. Gold has been in a bull market since 2015, but it's been a grinding, frustrating bull market with lots of false starts and failed breakouts. Now, with this 10-year resistance broken, we might be entering the acceleration phase. The phase where the gains come faster and bigger than anyone expects. But let's talk about the risks, because I'm not here to just pump gold. You need to understand both sides of this trade. What could derail this bull market? The biggest risk is a genuine strengthening of the dollar driven by economic growth and productivity gains. If the U.S. economy enters a period of strong, sustainable growth with low inflation, that would be bearish for gold. But look around. Do you see that happening? We've got slowing growth, persistent inflation, and a government that can't stop spending. That's not a recipe for a strong dollar. Another risk is a major deflationary event. If we get a 2008-style financial crisis where everything gets sold to raise cash, gold could get hit in the short term. But here's the thing. Even in 2008, gold only dropped about 25% from peak to trough, and it recovered within months. Meanwhile, stocks dropped 50% and took years to recover. So even in the worst-case scenario, Gold tends to be more resilient than other assets. The third risk is government intervention. If gold prices start rising too fast, governments could impose restrictions on gold ownership or trading. It's happened before. In 1933, President Roosevelt signed Executive Order 6102, which required Americans to turn in their gold to the government. Could it happen again? Possibly. But in today's globalized world with digital markets and international storage options, it would be much harder to enforce. Now let me show you something that's happening in the derivatives market, because this is where you can see the real stress in the system. The COMEX gold futures market has been showing signs of strain. Open interest is at elevated levels, but the amount of physical gold available for delivery is relatively low. We're talking about a paper-to-physical ratio that's getting stretched. What does this mean? It means there are a lot of paper claims on gold, but not enough physical gold to satisfy all those claims if everyone decided to take delivery at once. This is the kind of setup that can lead to a short squeeze. If a large player decides to stand for delivery and demand physical gold, it could force other players to scramble to find physical metal, driving prices sharply higher. We saw a preview of this in March 2020 when the gold futures market temporarily dislocated from the physical market. Futures prices were trading below spot prices, which should never happen. It was a sign that the market was breaking down. The situation resolved itself, but it showed how fragile the paper gold market can be. And here's something most people don't realize. The gold market is tiny compared to other financial markets. The entire above-ground gold supply is worth about $15 trillion. That sounds like a lot until you compare it to the global bond market at $130 trillion, or the global stock market at $100 trillion, or the global real estate market at $280 trillion. If even a small percentage of money from these other markets flows into gold, it could have an outsized impact on prices. We're talking about a market that could absorb hundreds of billions of dollars in new investment and see dramatic price appreciation as a result. Let me tell you about what's happening in the physical gold market right now, because this is where you see the real demand. Premiums on physical gold coins and bars have been elevated for months. When you go to buy a gold eagle or a gold maple leaf, you're paying $80 to $100 over the spot price. That's a significant premium, and it tells you that physical demand is strong. Refineries are running at full capacity. Wait times for delivery of physical gold have stretched out, and anecdotal reports from dealers suggest that wealthy individuals and family offices are buying physical gold in size. Not paper gold, not ETFs. Physical metal that they're taking delivery of and storing in private vaults. This is the kind of demand that doesn't show up in the official statistics until months later. But it's real, it's persistent, and it's coming from the kind of money that doesn't chase trends. This is old money, smart money, patient money that's making a strategic allocation to gold as insurance against what they see coming. Now, let's talk about what happens next, because breaking through 10-year resistance is just the beginning. When you look at the technical targets based on this breakout, things get really interesting. If you measure the consolidation range that gold was in from 2011 to 2024, and you project that range higher from the breakout point, you get a target around $2,800 to $3,000 per ounce. That's not some wild-eyed prediction. That's basic technical analysis based on measured moves. But here's where it gets even more interesting. If you adjust the 2011 high of $1,921 for inflation, using official CPI numbers, you get a gold price of around $2,650 in today's dollars. But if you use real inflation, the kind of inflation that ordinary people experience in food, energy, and housing, you get a number closer to $3,500 to $4,000. In other words, even at current prices around $2,100, gold hasn't kept pace with real inflation. It's still undervalued relative to the loss of purchasing power in the dollar over the last 13 years. For gold to truly match its 2011 high in real terms, it needs to go significantly higher from here. And that's assuming inflation stays under control. If we get another wave of inflation, if the Fed is forced to restart quantitative easing, if the government keeps spending like there's no tomorrow, gold could go much higher than anyone currently expects. Let me give you one more historical example, because I think it's relevant. In the 1970s, gold went from $35 per ounce to $850 per ounce. That's a 24-fold increase. But it didn't happen in a straight line. There were multiple phases to that bull market. From 1971 to 1974, gold tripled from $35 to $195. Then it consolidated for 3 years, frustrating everyone who thought the bull market was over. Then from 1977 to 1980, it went parabolic, rising from $150 to $850 in just 3 years. I think we might be at a similar inflection point now. We've had the initial move from $1,050 in 2015 to $2,100 today. We've had the consolidation and frustration. And now, with this breakout above 10-year resistance, we might be entering the acceleration phase. The phase where the real money is made. But here's what you need to understand. This isn't about getting rich quick. This is about preserving wealth in an environment where currencies are being debased, where governments are drowning in debt, where the financial system is more fragile than most people realize. Gold isn't going up because gold is becoming more valuable. Gold is going up because everything else is becoming less valuable. The dollar is losing purchasing power. Bonds are losing value as interest rates rise. Stocks are overvalued by almost any historical metric. Real estate is unaffordable for most people. Where else are you supposed to put your money? This is why central banks are buying gold. This is why wealthy families are buying gold. This is why smart investors are buying gold. Not because they think they're going to double their money overnight, but because they want to make sure they still have money when this current financial experiment ends. And make no mistake, we are in an experiment. We've never had a global monetary system based entirely on fiat currencies with no gold backing. We've never had central banks with balance sheets this bloated. We've never had government debt levels this high in peacetime. We've never had this much money printing, this much financial engineering, this much intervention in markets. Maybe it all works out fine. Maybe the Fed can engineer a soft landing. Maybe governments can grow their way out of debt. Maybe inflation stays under control. Maybe the dollar remains the world's reserve currency forever. But what if it doesn't? What if we're in the late stages of a monetary system that's running on fumes? What if the next crisis is the one that breaks the system? What if gold isn't just going to $3,000, but to $5,000 or $10,000 as the world scrambles for real money? I'm not saying that's going to happen, but I am saying it's a possibility that's worth preparing for. And the time to prepare isn't after the crisis hits. It's now, while you still can, while gold is still available, while you can still make rational decisions without panic. This breakout above 10-year resistance isn't just a technical event. It's a signal that something fundamental has changed in the market. A signal that the forces that kept gold contained for a decade are no longer in control. A signal that we might be entering a new phase in the gold market, one that could rival or exceed the great bull markets of the past. The question isn't whether gold is going higher. The question is how much higher and how fast. And the answer to that question will depend on how quickly the world wakes up to what's really happening in the financial system. Because here's the truth that nobody wants to talk about. The system is broken. It's been broken since 2008, maybe longer. We've been papering over the cracks with money printing and zero interest rates and quantitative easing and every other trick in the book. But you can't print your way to prosperity. You can't borrow your way out of debt. And you can't ignore reality forever. Gold knows this. Gold has always known this. That's why it's been quietly climbing for years while everyone was focused on stocks and crypto and real estate. And now, with this breakout, gold is starting to shout. It's telling you that the end game is approaching. It's telling you that the time to prepare is running out. So what happens next? I think we're going to see gold continue to grind higher, with periodic pullbacks that shake out weak hands. I think we're going to see more central banks announce gold purchases. I think we're going to see more investors wake up to the gold story. And I think we're going to see prices that would seem impossible today become reality in the months and years ahead. This is your moment. This is your chance to position yourself before the crowd figures it out. Because once everyone knows, once gold is on the front page of every newspaper and the lead story on every financial news channel, it'll be too late to get in at reasonable prices. The 10-year resistance is broken. The dam has burst. And what happens next is going to shock a lot of people. But it won't shock those who are paying attention. It won't shock those who understood what this breakout really meant. And it won't shock those who took action while they still could.